What if a single business decision could dismantle an entire empire? In 1988, Tenneco sold over $7 billion in oil and gas assets, the foundation of its power not to expand, but to survive. At the center of that choice stood a struggling tractor brand, J.I. Case. What followed was not an overnight collapse, but a slow unraveling. Within a decade, one of America's most powerful conglomerates was gone. This is the story of how loyalty, timing, and one machine reshaped corporate history. Chapter 1. The Rise of an Empire. The story begins in 1943, in the middle of World War II. The United States government faced an urgent problem: how to move natural gas from the oil fields of Texas to the factories of the industrial Northeast. The solution became two massive pipeline projects, the Big Inch and the Little Big Inch. To operate and manage these lines, a company was created, Tennessee Gas Transmission Company, the predecessor of Tenneco. The pipelines stretched for more than 1,000 miles. They were engineering achievements of wartime America. When the war ended, the infrastructure remained, and so did the company. Tennessee Gas went public, and in the post-war decades, it became a foundational player in the expanding American energy system. Natural gas was replacing coal as the fuel of choice for homes, factories, and power plants. Tennessee Gas owned the pipes that made that transformation possible. In 1966, the company shortened its name to Tenneco, but Tenneco's ambitions extended far beyond pipelines. The 1960s and 1970s were the age of the conglomerate, the belief that strong management could succeed in any industry. Diversification was seen as stability. Tenneco embraced that philosophy with extraordinary energy. It began acquiring companies across the industrial spectrum: packaging firms, chemical manufacturers, automotive parts suppliers. In 1968, Tenneco acquired Newport News Shipbuilding, one of America's most important military shipyards, an operation that would eventually become the nation's sole builder of nuclear-powered aircraft carriers. By the mid-1970s, Tenneco had transformed itself into one of America's most diverse industrial conglomerates. It was no longer just an energy company. It was a sprawling industrial empire. But one acquisition would come to define its future. In 1967, Tenneco purchased J.I. Case Company, one of the oldest and most respected names in American farm equipment. The deal cost several $100 million, a major investment by the standards of the time. At the moment it was made, the decision looked inspired. American agriculture was booming. Global demand for U.S. grain was rising, farm incomes were strong. Equipment sales were climbing. J.I. Case appeared to offer Tenneco something rare, a stable, iconic manufacturing brand tied to the most enduring of American industries. No one inside the company imagined that this red-painted tractor line would one day help unravel the entire conglomerate. Chapter 2. The Fatal Attraction. J.I. Case was not just another manufacturing subsidiary. Founded in 1842 by Jerome Increase Case in Racine, Wisconsin, it was one of the oldest continuously operating industrial brands in the United States. For generations of farmers, the Case name carried weight. It represented durability, heritage, and American craftsmanship. To Tenneco's leadership, Case was more than a line item on a balance sheet. It was a symbol, a tangible connection to the heartland, a business that felt permanent. Throughout the 1970s, that feeling seemed justified. American agriculture was in the middle of a historic expansion. The Soviet Union became a major buyer of U.S. grain. Crop prices rose sharply. Farmers borrowed expanded acreage and modernized equipment. Tractor sales surged. Case benefited directly. Revenues climbed. Dealer networks expanded. For a time, the farm equipment business appeared to validate Tenneco's belief that diversification could be both profitable and noble. But beneath the surface, the industry was unforgiving. Unlike pipelines or regulated energy infrastructure, farm equipment was a brutally competitive market. Case faced John Deere, a rival with enormous scale, unmatched dealer loyalty, and deep reserves of capital. Margins were thin. Product cycles were relentless. Price competition was constant. Even more dangerous was the industry's volatility. Farm equipment demand is tied directly to agricultural income. which itself depends on commodity prices, weather, credit conditions, and government policy. In good years, manufacturers thrive. In bad years, sales can collapse almost overnight. Tenneco had built its empire in businesses where cash flows were relatively stable. Case existed in a world where fortunes turned with the harvest. That vulnerability would soon be exposed. Chapter 3. The crisis hits. January 4th, President Jimmy Carter announced a grain embargo against the Soviet Union in response to the invasion of Afghanistan. The Soviet Union had been one of the largest buyers of American wheat and corn. With a single policy decision, a major export market disappeared. The consequences rippled through American agriculture. Grain prices dropped sharply. Farm incomes fell. Credit tightened. Farmers who had expanded aggressively during the boom years found themselves over-leveraged in a collapsing market. The farm economy of the Midwest entered what would later be known as the farm crisis of the 1980s. For equipment manufacturers, the impact was devastating. Farmers did not merely postpone purchases, they stopped buying altogether. Some defaulted on loans, others liquidated equipment. Dealer lots filled with unsold tractors. At J.I. Case, the downturn was sudden and severe. Sales fell sharply across product lines. Plants ran below capacity. Cash flow deteriorated. What had been a profitable division only a few years earlier became a major drain on Tenneco's resources. Across the industry, even giants began to stumble. International Harvester, one of America's most iconic manufacturers and Case's chief rival, was pushed to the edge of collapse. Thousands of farm foreclosures swept across rural America. Community banks failed. Entire towns were hollowed out. For Tenneco, this was the moment of reckoning. The company could treat Case as what it now appeared to be, a cyclical business in structural decline. It could shrink operations, conserve capital, and wait for conditions to stabilize. Or it could attempt something far more ambitious. James Kettleson, who had become Tenneco's chief executive in 1978, chose the second path. He believed that the farm equipment business was not doomed, only wounded. He believed that scale, consolidation, and investment could restore competitiveness. And he believed that J.I. Case was too important, too historic to abandon. That belief would drive one of the most consequential corporate gambles of the decade. Chapter 4. The Disastrous Gamble. To understand what happened next, you need to understand James Kettleson. Kettleson was not reckless. He was respected, thoughtful, deeply invested in the idea that American manufacturing could be preserved with the right leadership. But he was also personally attached to J.I. Case in a way that went beyond spreadsheets. Inside Tenneco, Case was often described not as a division but as a mission. Kettleson believed the crisis in agriculture was cyclical, not structural. He believed that if Case could survive the downturn, it would emerge stronger. And he believed that scale was the key. In 1984, he made a decision that stunned the industry. Tenneco acquired the agricultural equipment business of International Harvester, a once dominant manufacturer that had been crippled by labor disputes, product delays, and mounting losses. The deal involved hundreds of millions of dollars in cash and the assumption of substantial liabilities. Overnight, Case doubled in size. The logic was clear. By combining Case and International Harvester, Tenneco hoped to create a single entity large enough to challenge John Deere. Manufacturing could be consolidated, product lines rationalized, dealer networks unified, costs would fall, market power would rise. On paper, it looked like industrial logic. In practice, it proved far more complicated. Farmers are intensely loyal to brands. International Harvester customers did not automatically become Case customers. Many simply defected to John Deere. The promised efficiencies were slow and painful. Different factories produced incompatible machines. Part systems did not align. Engineering cultures clashed. The merged company inherited aging product lines and high fixed costs at the worst possible moment in the agricultural cycle. Most importantly, the downturn in farming was not brief. American agriculture was undergoing a fundamental transformation. Debt levels, land values, and global competition were reshaping the industry. The era of rapid expansion was over. By the mid-1980s, the case operation was losing hundreds of millions of dollars annually. And yet the response inside Tenneco remained the same. Invest more, modernize, hold the line. The belief persisted that abandoning case would mean surrendering not just a business, but an identity. Chapter 5. Selling the crown jewels. By the late 1980s, Tenneco faced a growing crisis. The conglomerate carried more than $6 billion in debt. Credit markets were tightening. Analysts questioned whether a company with such diverse operations could sustain heavy losses in farm equipment while funding growth elsewhere. Something had to give. Many on Wall Street believed the answer was obvious. Divest the farm equipment business, cut losses, focus on energy pipelines and industrial operations that generated consistent cash. But that was not the choice Tenneco made. In 1988, the company announced that it would sell major portions of its oil and gas exploration and production assets. Over a series of transactions, Tenneco raised approximately $7.3 billion. These were not marginal properties. They were the assets that traced directly back to the company's origins. Energy had funded Tenneco's expansion. It was the business that had made diversification possible in the first place. The official rationale was balance sheet strength, reduce debt, reassure creditors, and stabilize the company. But to many observers, the symbolism was unmistakable. Tenneco was selling its most valuable, most reliable business while retaining its most troubled one. Analysts struggled to understand the strategy. One compared it to eating the seed corn, consuming the very resources needed for future growth. The timing compounded the risk. Oil prices in the late 1980s were relatively weak. Energy markets would strengthen in the years that followed, meaning the assets Tenneco sold would soon command higher valuations. The proceeds from the sales were used to reduce debt and support ongoing operations across the conglomerate. They bought time. They did not resolve the underlying imbalance. Tenneco had traded long-term stability for short-term survival, and Case still lost money. Chapter 6. The Death Spiral. After the energy divestitures, Tenneco was no longer the company it had been. What remained was a collection of manufacturing and industrial businesses, dominated by a farm equipment division that continued to struggle in a transformed agricultural economy. The sale of the oil and gas assets bought time. It did not restore profitability to Case. Losses persisted. Restructuring continued. Plants closed. Product lines were consolidated. Thousands of jobs disappeared across the Midwest and beyond. Yet even as the organization shrank, the fundamental problem remained. The scale and economics of the farm equipment business no longer aligned with Tenneco's financial reality. In 1991, James Kettleson retired. His successor, Michael Walsh, inherited a company that had already sacrificed its historical core and still faced relentless pressure from investors. Unlike Kettleson, Walsh did not see Tenneco as a single organism to be preserved at all costs. He saw a set of parts. By the early 1990s, Wall Street had reached a conclusion that was impossible to ignore. Tenneco was worth more in pieces than as a whole. The market valued the conglomerate at less than the combined value of its individual businesses. Activist investors began to demand structural change. Walsh agreed. In 1994, Tenneco spun off its farm and construction equipment business as a separate public company, Case Corporation. The market reaction was immediate and positive. Investors welcomed the removal of what had become the company's most visible burden. The irony was brutal. The division that had consumed so much capital, attention, and identity was finally separated, and the parent company's valuation improved. But by then, the original Tenneco was already beyond recovery. Chapter 7. The Final Dismemberment. Once Case was gone, the rationale for Tenneco's existence as a conglomerate evaporated. The remaining businesses, automotive parts, packaging, shipbuilding, industrial manufacturing, had little strategic connection to one another. There was no unifying logic beyond history. In 1996, Michael Walsh announced that Tenneco itself would be broken apart. The empire dissolved. Operations were spun off or sold. Shipbuilding became an independent company, and was later acquired by Northrop Grumman. Automotive operations evolved into a narrower industrial firm that retained the Tenneco name but bore little resemblance to the original conglomerate. The organization that had once spanned energy, transportation, manufacturing, and agriculture ceased to exist as a unified enterprise, and Case, the company Kettleson had fought so hard to preserve, struggled as an independent entity. In 1999, it merged with New Holland to form CNH Global. Over time, that lineage passed into the hands of European ownership, eventually becoming part of CNH Industrial. Today, Case exists as a brand within a multinational corporation. It survives, it builds machines, but it never became the dominant force Kettleson envisioned. John Deere remains the industry's standard-bearer. The war was fought, the sacrifice was made, the outcome never changed. Tenneco did not fall to rivals or disaster. It unraveled through belief. Year after year, a struggling tractor business consumed resources while the world changed around it. To save that legacy, an empire sold its future. The pipelines vanished. The energy core disappeared. The conglomerate dissolved. Today, only a brand remains. When you see a Case tractor in a field, remember, it is not just a machine. It is the monument of an empire that refused to let go. Tenneco did not fall to rivals or disaster. It unraveled through belief. Year after year, a struggling tractor business consumed resources while the world changed around it. To save that legacy, an empire sold its future. The pipelines vanished. The energy core disappeared. The conglomerate dissolved. Today, only a brand remains. When you see a Case tractor in a field, remember, it is not just a machine. It is the monument of an empire that refused to let go.